Imagine for a second that you are walking through the financial district of a major city.
Like New York, London, Tokyo.
Yeah, exactly. Pick your favorite skyline. And you look up, and there's this gleaming $50 million office tower.
Or maybe a historic five-star luxury hotel.
Right. Now, usually you look at that and think, well, someone rich owns that.
A massive conglomerate or a pension fund.
Yeah, some tycoon. But the thought process usually just ends there, right? With, I will never own a meaningful piece of that.
Because it's too far out of reach. The barriers are massive.
Capital regulation.
Access, it's basically a closed club.
Exactly. But imagine if you could pull out your phone, tap a screen, and buy a piece of that building right then and there.
And not just a share in a REIT, right, where you don't even know what buildings are in the portfolio.
No, I mean, literally owning a fraction of that specific structure you're looking at. Or imagine owning a stack of government bonds without needing a massive brokerage account.
Or waiting days for the paperwork to clear.
Right. Now, it sounds like science fiction.
Or financial fiction.
Financial fiction, yeah. For most people, the idea that high-value, totally illiquid assets are accessible to anyone with a smartphone instantly is just, it's crazy.
But according to the research we have in front of us today, it really isn't just a daydream anymore.
No, it's not. We are talking about one of the most, frankly, significant shifts in the crypto space. It's a concept called real-world assets.
RWA.
RWA, yeah. And before you roll your eyes, listener, thinking this is just another crypto buzzword, stick with us, because this is fundamentally different.
Yeah, it's crucial to make a distinction right early on here. We aren't talking about another meme coin.
Or a picture of a pixelated rock.
Right. When we talk about RWA, we're talking about a digital title deed.
A digital deed.
Yes, that lives on a blockchain,
Yeah.
representing something that actually exists in the physical world.
Okay, let's unpack this, because the promise here is massive. We're looking at how the crypto world is maturing.
Growing up, really.
Exactly.
Yeah.
Moving from pure speculation to actually digitizing the real economy. So our mission for today's deep dive is to explore how traditional stuff, real estate, gold, bonds, is moving on-chain.
And we have a great stack of sources today.
We do. It breaks down the whole RWA landscape. We've got market predictions from groups like Boston Consulting Group.
BCG, yeah.
And some very heavy-hitting institutional moves from players like BlackRock, plus the actual specific use cases that are live right now.
It's a fascinating pivot. It's where the efficiency of decentralized ledgers finally meets the stability of traditional finance.
And frankly, it's about time. So let's just dive right in. The first thing that really jumped out at me from the reading was this idea of the fractional revolution.
Which sounds like a political movement.
It does, but it's financial.
Though in a way, it is a democratization movement.
Right, because the biggest barrier to traditional investing has literally always been the price tag. The entry price for the good stuff is just, it's too high.
Most people cannot afford to buy a $50 million office building.
I certainly can't. You can't just call up a broker and say, I'll take the high-end private equity portfolio, please.
Precisely. That is the ultimate gatekeeper. High capital requirements keep the most lucrative or stable assets in the hands of the very few.
And if you wanted exposure to commercial real estate or private credit historically, you basically had to be an accredited investor with millions in the bank.
But this is exactly where RWA introduces the concept of fractional ownership.
So break that down for us. How does that work mechanically?
Think of it this way. RWA takes a massive asset. Let's stick with that luxury hotel you mentioned earlier.
Okay.
And it breaks the ownership structure of that asset into millions of digital tokens. Mechanically, what happens is you place the asset inside a special purpose vehicle.
An SPV, like a legal entity.
Exactly, a legal entity. And then you issue tokens that represent shares of that specific entity.
So instead of one paper deed locked in a banker's safe somewhere, there are a million digital deeds floating on the network.
Exactly. And this allows an investor, someone who might only have $100 or $1,000, to actually hold a stake in that hotel.
You hold the token, you hold the claim.
Right. And because it lives on a blockchain, the transfer cost is basically negligible. You can economically justify selling a $100 slice of a building.
Whereas in the old world, the legal paperwork alone would cost more than your $100 investment.
We're way more.
It's almost like crowdfunding, but with actual enforceable legal ownership rights encoded on a blockchain.
Yeah, and what's fascinating here is the sheer scale. It's really easy to dismiss this as just a niche trend for tech enthusiasts.
But the numbers tell a totally different story.
They absolutely do. We look at a projection from the Boston Consulting Group, BCG, and they are incredibly bullish on this.
I saw that statistic in the source material, and I literally had to double-check it. It just seemed way too large.
It is staggering.
Yeah.
BCG estimates that by 2030, the tokenization of illiquid assets could reach $16 trillion.
16 trillion. I mean, that is a difficult number to even wrap your head around. That's roughly the GDP of China.
It is. But what it signifies is that this isn't just a simple tech upgrade.
We aren't just slapping a shiny digital interface on the current stock market.
No, this represents a global overhaul of how we define and transfer ownership entirely. They aren't talking about tokenizing things that are already easy to trade, like Apple stock.
Right. They're talking about unlocking value in things that are currently illiquid. Private equity, infrastructure, real estate.
We are moving from a world where ownership is clunky, paper-based, and highly exclusive, to a world where it's fluid, digital, and extremely granular.
It really changes the whole texture of the economy. But, usually when we talk about crypto on this show, it feels a bit like the Wild West.
Volatile, unregulated.
Yeah, bit scary for the average person. You picture anonymous developers with anime profile pictures, but this really sounds different.
It is different. And the reason it feels different is because the characters in the story have changed.
We aren't just talking about anonymous coders anymore.
No, we are talking about the adults in the room.
And by adults, we are specifically talking about BlackRock.
The world's largest asset manager. You literally cannot get more establishment than BlackRock.
No, you can't.
Their entry into this space changed the conversation entirely. When they move, the entire financial tectonic plate shifts.
They launched a fund recently, right?
They did. It's called BUIDL. BUIDL. And it launched directly on the Ethereum blockchain.
Which is just wild to think about. BlackRock building on Ethereum. They didn't go and build their own private little walled-off database.
No, they used the public chain. It is a massive validation. Now, there is a nuance here we definitely need to clarify for the listener.
Right, it's not a free-for-all.
Exactly.
Yeah.
BUIDL is currently a permissioned product. That means it's designed for institutional and qualified investors.
So you or I can't just go buy it on a whim today on our phones?
Not today, no. It's essentially a VIP section of the blockchain.
Okay, got it.
But for now, its mere existence is a major signal. It proves that blockchain is no longer fringe technology. If BlackRock is using it, the tech has graduated.
And I remember reading a quote in our sources from Larry Fink, the CEO of BlackRock, that really stuck with me. He didn't just say, oh, we're trying this out as an experiment.
No, he went much further than that. He stated that the next generation for markets is the tokenization of securities.
So what did that actually mean for the market? Why is he so aggressively bullish on this? Is it just about being modern or for the aesthetic?
It's definitely not for the aesthetic. It is fundamentally about the plumbing of the financial system. Larry Fink, and really the industry at large, is chasing instant settlement.
Right, because right now, if I sell a stock or a bond, I don't actually get that money instantly. It feels instant on the screen, but it's not.
Exactly. You're dealing with what's called T+2 settlement cycles.
Yeah.
You're waiting 2 whole days for trades to clear through all the traditional banking layers.
The clearinghouses, the intermediaries.
Yeah. And for you or me, waiting 2 days for a bank transfer is just annoying. But for a firm like BlackRock, moving billions of dollars,
2 days of dead capital sitting in limbo is a massive expense.
a huge opportunity cost. So tokenization aims to fix that by making it T+0.
The trade is the settlement.
Exactly. The asset and the money move simultaneously. It eliminates counterparty risk and frees up that liquidity instantly.
It's basically making money move at the speed of an email.
That is the perfect analogy. Just like you don't wait 3 days for an email to arrive across the globe, you shouldn't have to wait 3 days for your money to arrive.
Okay, so we have the theory down and we see the big institutional backing, but I want to get practical for the listener here.
Sure.
Apart from generic quote-unquote assets or these big institutional funds that we can't even buy yet, what can you actually buy as a token today? What's actually being tokenized right now?
The source material highlights 3 main pillars, 3 sectors that are the most active right now.
Let's go through them. What is number one?
The first, and currently the most active sector by far, is Treasury bills, T-bills.
Government debt. I mean, it's not exactly the sexiest asset, is it?
Boring is good in finance. That might not be sexy, but it is the absolute bedrock of the global financial system, and now it's on-chain.
So how does a tokenized T-bill work?
Investors can hold tokens that are backed one-to-one by U.S. Treasury bills. The issuer manages the actual bond purchase in the traditional market, and the token tracks that value.
Okay.
This allows investors to earn yields, often in that 4 to 5% range, depending on where Fed rates are, directly in their digital wallets.
That is really interesting because usually if you hold crypto, say stable coins, you're just holding them. They don't yield anything unless you go and do something risky with them in DeFi.
Exactly. If you have 10 grand in a stablecoin, it's just sitting there losing purchasing power to inflation.
But this offers a way to put that capital to work without ever leaving the blockchain ecosystem.
It bridges the safety of government-backed debt, the risk-free rate, with the sheer utility of crypto.
Okay, so that's the safe, steady pillar. What is the second one?
Gold and commodities.
Now, this one I totally get. Gold bugs have been around forever.
They absolutely have. But physical gold is a massive headache.
Oh, yeah.
It's heavy, you have to store it, you have to constantly worry about theft. If you buy a physical gold bar, you're constantly looking over your shoulder.
Or you have to pay someone else to store it in a vault, and then you pay ongoing fees. And if you ever want to sell it, you have to ship it back to a dealer just to verify it isn't painted lead.
Right, the friction is huge. So the example the source material gives here is KAXG. It's a token where each individual unit is backed by one fine troy ounce of gold. And that gold isn't imaginary. It's physically stored in Brink's vaults in London.
And the serial numbers of the actual bars are matched to the tokens.
Yes, so it's the real deal. And here's the aha moment for this use case. It combines the stability of a 5,000-year-old physical asset with the speed of a digital transaction.
You get the ownership of physical gold without the logistical nightmare of storing physical bars in your basement.
Exactly. You can send $100,000 worth of gold to someone in Singapore on a Sunday night, and it settles in seconds.
That is pretty cool. It's essentially like teleporting gold bars.
Essentially, yes.
Yeah.
You have all the ownership without any of the burden of possession.
Okay, so we have T-bills and we have gold. What is the third pillar?
Real estate. And this is the one that gets people the most excited. It's really seen as the holy grail of RWA.
For sure. Everyone wants to be a real estate mogul.
The benefit here is very clear. You can buy a token representing a share of a property, say 1/1000th of an apartment complex, and then the rental income is distributed via smart contracts.
So if the tenants pay their rent, I get my little fractional slice of it automatically dropped into my digital wallet.
Correct. It significantly reduces the manual bureaucracy of cutting checks and calculating percentages for hundreds of investors.
Okay, but I have to play devil's advocate here for a second.
Go ahead.
I own a house, and I know firsthand that passive income in real estate is a bit of a lie.
It rarely is truly passive.
Things break. Roofs leak. Toilets clog. Does the blockchain fix the leaking roof?
That is the critical question, and the answer is a definitive no. The blockchain is a ledger, it is not a handyman.
I figured as much. So who actually fixes the roof?
A human property manager still has to physically go there, hire a plumber, and pay the invoice. The RWA token replaces the settlement process, the lawyers, the title transfer, the distribution of the funds. It does not replace the operations.
So we aren't automating the physical maintenance of the building, just the financial ownership layer.
Exactly. RWA streamlines the office work, not the yard work.
That's a great way to put it. And this brings me to another really important point. There is this common myth in crypto that blockchain just removes all middlemen.
You hear it all the time.
Kill the middleman. Disintermediate everyone. But based on what you just said about property managers, that's not entirely true, is it?
No, it's not. And we really need to correct that record based on the research. RWA doesn't remove middlemen, it transforms them.
How so? Who stays and who goes in this new system?
Well, the trust layer still absolutely needs humans. Regulators, custodians, lawyers. They still exist. They have to.
Because someone has to verify that the gold is actually sitting in the Brink's vault.
Exactly. Someone has to ensure the legal title of the building is valid in the real world and that local securities laws are being followed.
So the roles are still there?
They are, but the process changes fundamentally. The blockchain becomes the single source of truth.
Single source of truth. I like that phrase. What does that mean practically for the market?
In the traditional financial world, if I sell you an asset, my bank has a ledger, your bank has a ledger, the clearinghouse has a ledger, and the custodian has a ledger.
And they all have to reconcile with each other at the end of the day.
Right. And that takes time, it takes money, and it creates errors. With RWA, the blockchain is the ledger. Everyone looks at the exact same data simultaneously.
So we don't need title agents spending weeks verifying a deed history because the history is immutable and visible on the chain.
Exactly. It makes transactions vastly faster and more transparent.
And there's another major change related to middlemen and institutions that the sources pointed out, and that's the concept of time.
Yes. This is a huge shift in how we think about markets.
Because traditional markets sleep. I mean, try to sell a stock on a Saturday night.
You can't.
You're stuck until Monday morning.
Right. Banking hours. It's a concept from a completely different century. The market essentially freezes for 2/3 of the week. But RWA-backed tokens trade 24/7, 365 days a year.
So liquidity is available whenever you actually need it.
Whenever. If you need to sell your gold token at 3 a.m. on a Sunday, you can. That liquidity premium is massive. It changes the fundamental nature of the asset class.
Because real estate is traditionally highly illiquid, it takes months to sell a house.
But tokenized real estate could technically be sold in seconds.
It's really bringing finance into the internet age. The internet doesn't close at 5 p.m. on a Friday.
Precisely. It's always on.
But looking at all this and playing devil's advocate again, because that's my job. This sounds great, but what happens if things go wrong? Is this magic? Can we just code away the real world problems?
No.
Oh.
And this is probably the most important section for you, the listener, to understand today. Do not mistake the map for the territory.
Okay, unpack that.
RWA is not a magic solution.
Mm.
It is deeply, inextricably tethered to the physical world, and that brings real-world risks.
So if it's tied to the real world, it carries the baggage of the real world.
It does. We talk about something called the legal bridge.
The legal bridge, what is that?
A token is just code. It's a digital receipt on a network. It is only valuable if there is a strong legal framework tying it to the physical asset.
The digital deed must hold up in a real court of law.
Exactly. If I hold a token, but a judge says, I don't recognize this token as proof that you own the house,
Then the token is just worthless code.
it's totally worthless. The connection between the on-chain record and the off-chain law is where the primary risk lies right now. And then, of course, there are physical realities.
Like we mentioned the leaking roof earlier.
Right. But what if the building burns down? What if the real estate market crashes and the property severely devalues?
The token can't protect you from a fire or a market crash.
No. You cannot code away fire damage. If the asset loses value in the real world, the token reflects that loss instantly.
You are trading a real asset with all its real-world risks.
You aren't escaping reality, you're just accessing it differently.
That is such a key takeaway from these sources. We aren't creating a fantasy land. We're creating a highly efficient digital map of the real land.
Exactly. RWA doesn't magically make a bad investment good.
It just makes the investment easier to access, which also means it's easier to lose money quickly if you pick the wrong asset.
Precisely. It removes the friction, but friction sometimes protected people from making terrible impulse decisions. Now, the responsibility is entirely on you.
So let's wrap this up. We have covered a lot of ground today. We've gone from the $16 trillion BCG projection to BlackRock upgrading the plumbing of finance to buying fractions of gold and government bonds on your phone.
Yeah, and if we summarize the sources, the main takeaway is that the era of purely speculative cryptos, the dog coins and the crazy hype cycles, is maturing.
RWA is the bridge connecting the efficiency of blockchain with the stability of the physical world.
It's not about escaping the traditional financial system anymore.
No, it's about upgrading it. It's about upgrading the operating system of the global economy to work at the speed of the internet.
Completely agree.
And that brings us to the end of today's deep dive. But before we go, we always like to leave you with something to chew on.
Something that wasn't explicitly in the reading but stems directly from everything we've talked about today.
We've talked a lot about liquidity today, about how easy it will be to buy and sell fractions of basically everything.
Right. 24/7, instant swapping of assets.
So consider this. Right now, ownership is a heavy commitment. You buy a house to live in for 30 years. You hold physical gold for decades.
But in an RWA world where friction is near zero, will the concept of ownership eventually become as fluid and temporary as streaming a song?
Wow. Explain that a bit more. What do you mean?
Well, imagine swapping your ownership of a London apartment for a Tokyo loft just for a week, or trading your gold tokens for Apple stock for an hour just to catch an earnings report.
Because the settlement is instant and cheap.
Right. If everything is perfectly liquid, does ownership lose its permanence? Does it just become a temporary usage right?
That is a wild thought. Are we moving toward a Spotifyification of real estate and hard assets?
We might be. A world where you have access to everything, but own nothing permanently.
Something to really think about. Next time you walk past that massive skyscraper, maybe one day you'll own a brick of it for about 5 minutes. Thanks for joining us on this deep dive. We will see you next time.